Hello, everyone out there. You are listening to Gabe, Elton. I am hosting the Austin Report on the one and only Rents Radio Network. Today is Wednesday, December 10th, and you are hearing me live on premises here at Austin Rare Coin and Bullion in Austin, Texas. The Dow Jones ended trading today down more than 200 points. It's being beaten down heavily, almost on a daily basis. It was down triple digits on Monday, had a small bounce yesterday, but again, the rout continued today. Most of the downward pressure that we saw in stocks, or most of it is being blamed on the falling oil price. Now, obviously, that's supposed to be good for the economy. But as we look more into this in detail, something that we'll cover here in a few minutes, you're going to find out that it is actually extremely bad. And one of the things I think that's a precursor of what's to come in the economy for 2015. And that's another thing that we're going to touch on tonight is our outlook for 2015. What the analysts and researchers here at Austin Rare Coins think that is going to happen in the coming months and years. Gold and silver stood very strong today through the selling pressure that we saw in the stock market. Gold traded as high as $1,239. It currently sits at $1,232. Silver gained 9 cents on the day and currently sits at $17.15. But there's been some really interesting developments in the precious metals markets over the last several weeks, and I believe that it indicates that the bottom is in for both metals. One of the things that really, I think, started this process was on Sunday, November 30th. There was a Swiss referendum. Many of you probably heard about that vote they were having over in Switzerland. And they were voting on whether or not they wanted to peg the franc to gold. Well, that measure failed, and that vote happened on a Saturday. Well, by Sunday, November 30th, gold and silver started a nosedive in price. And as always, it was during a time when the U.S. market was closed, and it was on a Sunday. And, of course, no one had access to the markets and could have taken advantage of this. But gold fell all the way to $1,145. Silver fell all the way to $14.45. As I was watching this, I was dumbfounded. You know, it bothers me sometimes that periphery events like a Swiss vote would cause such a huge swing in prices when fundamentally nothing really changed at all. However, by Monday, December 1st, the metals started a big upswing. Not only did they recover everything that they had lost, but they also gained a bit. In fact, since November 30th, when these lows were set on that Sunday, silver is up 18% from that low of $14.45. Gold is up 7.5%, and that's just over the course of the last 10 days. Now, these moves are huge, but when you hear the underlying information that I'm about to share with you, and when you factor that in, I think you're going to agree that the dog days in gold and silver seem to be over, and there are potentially huge price increases on the horizon. I had a client really struck home with me, came in the other day. It was her first purchase with our company. It was a referral, happened to be one of my client's mothers. And I got to sit down with her and you know, kind of pick her brain. And I thought it gave me some insight as to the thinking out there of the general American public these days. And basically, well, first thing, I have to give her props for starting to buy silver in the first place. But she mentioned, you know, she was a little disheartened with gold and silver, and that they had never really performed during her entire lifetime. Now, keep in mind, this lady was 50 years old. And it got me to thinking, the general public out there, they have such short memories. Maybe that all of us, and one of the first things I did is reminded all my salespeople of what gold and silver have done over the last 15 years or so. And I started writing a report and started gathering information about for that report and doing a little research. And the president of the company, Ryan Denby, is actually the one who's going to write the thing, but I helped with a lot of the research here. And it made me realize that people have forgotten about the financial panic of 2008. They forgot what happened in the stock markets in such a short amount of time. They forgot that their retirement accounts evaporated. They forgot that the time that they were going to be able to retire at age 60 turned to 70. And people have forgotten the growth of gold and silver and the performance of gold and silver and how it has outperformed any other major asset class on the planet. Even after the last 2 to 3 years since 2011, which has been horrible for gold investors. And some of that information I'm going to share with you here. But she, in her mind, believed that the only place to make real money as far as an investment goes was the stock market. And it got me to thinking that we need to tell this story, and I want to share this story with you guys. And basically what you're going to hear from me tonight is some of the research that we are doing for part of our 2015 Precious Metals Outlook that we will be releasing the early part of January. So I started putting together all of this information, and we're going to look at 3 major issues that we think is going to be driving the gold and silver markets throughout 2015. So the first thing that we wanted to take a look at is recent market performance compared to long-term market performance. Now, there's no doubt, as I mentioned, over the past few years, there's been a strong uptrend in stock prices, and there's been a strong downtrend in precious metals prices. However, if you go back to the low of the Dow Jones in 2009, which was 7,000 points, and you look at where it's trading today, it's up about 250%. In fact, slightly more than 250%, closer to 255%. The S&P during the same time frame is up 280%. Oil, even at $67 a barrel, I think it was down another 5% today, and that is not factored into this figure. Oil is up 55%. Gold is up 33%. Silver is up 33%. In 2009, the gold was $910 per ounce. In February of 2009, silver was $12.50 per ounce. Now, obviously, from 2009 to 2011, gold and silver were the top performing assets on the planet. Gold reached a high of $1,900. In 2 years, it went from $910 to $1,900 per ounce. Silver went from $12.50 to $48 per ounce. Now, since then, obviously, they've fallen. Gold is down about 37%. Silver is down about 65%. However, they're still up, even after this pullback. From the lows in 2009, gold is up 33%, silver is up 33%. But let's go back a little further, because this is where I believe America has a problem of short-term memory loss. If you go back to 2001, which happens to be the time that I got into the gold and silver business, the report that we're going to do is actually being nice and saying gold was $255 an ounce, but I actually remember gold at $249 per ounce. We're using the figure in the report for silver of $4.10. I actually recall it being $3.79, I believe. But if you take a look at those figures and you compare it to where the Dow Jones was in 2001, people don't remember that in 2001 the Dow Jones was 10,900 points. So people that think this lofty level of stock, the Dow Jones trading at more than 17,000 points and everybody's made a ton of money, that's only true if you bought at the absolute bottom in February of 2009. You would have made 255%. If you timed the stock market perfectly, you would have made 255%. But guess what? Most of Americans aren't day traders. Most of Americans aren't Goldman Sachs. Most of Americans are actually losing money on their stock portfolios, even in the face of these dramatic gains. However, let's assume that you were able to time the market perfectly. You gained 255%. Well, what about the long-term investor? What about those people who have owned stocks since 2001? What are they looking at? Well, gold's up 470% since then. Silver's up 410% since then. The Dow Jones is up 70%. Gold and silver are outperforming stocks by a factor of 4, even after the last 2.5 years where gold has fallen 37% and silver has fallen 65%. So those people, and a lot of my listeners tonight, a lot of the people who will hear this afterwards, you might be feeling down on yourself for missing out on such a dramatic swing in the stock markets and missing out on a dramatic fall in the gold and silver prices. We're in the best performing asset class on the planet. And since 2001, an asset class has outperformed stocks by a factor of 4. Yet the general American public believes that the only place to invest money is in the paper stock market. And from the things that we're seeing, there is a strong indication that all of that is going to come to an end, possibly abruptly, and I believe soon. All of the factors are saying that this is what is coming and that now is the time to prepare by buying gold and silver. So if you haven't visited our website, which is www.austincoins.com, please do so today. You could also give us a call at our direct number, which is 1-800-928-6468. You can visit our Learning Center from the web page. You can visit our YouTube channel there. Give us a call. We think you'll find our expert advice very timely and very helpful. And I'm going to go out on a limb and say you're not going to hear the direction and the knowledge at any other coin company in the United States that you talk to until you call Austin Rare Coin and Bullion. But I mentioned with this report, which, by the way, if you visited our website and if you give us a call, we can make sure that you receive this report for absolutely free. Another thing you can do is fill out a form on our website, and we'll send you a free Kennedy half dollar. Now, it's not a silver half dollar. It's a 2014 Kennedy half dollar, but we're willing to pay you to get this information. And so the first factor that I wanted to point out, and the first thing we want to cover in this report, is the fact that gold is still, even after this recent pullback, the best performing long-term asset on the face of the planet since 2001. And that's even after the pullback that we've seen recently in gold and silver, and it's even after the dramatic increase in the price of stocks. Because let me assure you, from 10,900 points in April of 2001 to 17,900 points earlier this week, that's a 70% move. And for 15 years, I don't believe that at all is going to repay the risk that you take by investing in a paper stock market. On the other hand, you can invest in what's been considered money for thousands of years, gold and silver, and a tangible asset, and you would have been 4 times better off over the last 15 years. I think this run-up that we've seen in stocks and the fall that we've seen in gold and silver are beginning to come to an end. And I mentioned that dramatic swing from November 30th until today in the price of gold and silver. We think that's a major factor. Another factor that we think is this, what we're looking at is these percentage moves. You know, we believe that it's time for the cycle to turn the other direction. It's time for the pendulum to swing. And everything that we are seeing is pointing to that direction of much higher gold and silver prices in the very near future. One of the things that we've been looking at very closely, and I know Charlie McGrath, who runs Wide Awake News and who I'm sitting in for tonight, recently did a video called The Canary in the Coal Mine. I would recommend everyone take a look at that because that is what oil is right at this time. It is the canary in the coal mine. Both gold and silver and oil are acting very similarly to what they were acting like back in 2008, right before the last major crisis. Gold and silver fell before the price of oil. Now oil has started to fall. The price is getting so low that it's below break even for a lot of these U.S. drillers that are just getting into the shale oil. And the reason why this is so important is because the counterparty risk run wild. In other words, if you can't afford to drill for oil, well, then you can't afford to pay back the loans on your other rigs. And this bank owes money to this bank. This company owes money to that company. And it's when it's all starts to come crashing down. It reminds me of subprime, right before the subprime market went to pieces. And 1/3 of the S&P 500 is based on capital expenditures from the energy sector. In other words, if the energy sector goes down the tubes, you could expect for 1/3 or close to it of the S&P 500 capital expenditures to fall, which is going to have a dramatic effect on the economy. People think this low oil price is good for consumers, which it is, but it's terrible for the overall economy. And it's terrible for the energy producers. It's terrible for the banks. In fact, a lot of the financial stocks have been falling because they're so leveraged in the energy sector. And Reuters recently came out with a report that showed that oil permits for new wells are down 40% across the United States in November. So a 40% drop-off in one of the most important parts of the economy. In fact, I'll say probably the brightest and probably the lone bright spot of the economy over the last 5 years. Reuters goes on to say, data provided exclusively to Reuters on Tuesday by industry data firm Drilling Info Incorporated showed 4,520 new well permits were approved last month, down from 7,227 in October. That's month to month. That's not year to year. It's down 40% month to month, which is huge. It goes on to say new permits, which indicate what drilling rigs will be doing 60 to 90 days in the future, showed steep declines for the first time this year across the top 3 U.S. onshore fields, which is the Permian Basin, which is close to Austin, Eagle Ford, which is even closer, and North Dakota's Bakken Shale. And there's a nice chart in the article that shows there's a break-even price, and the price is $70. Well, guess what? Oil almost fell into the $50 price range today. It was floating right above 60. And 70 is the break-even. And it accounts for 30% of CapEx spending on the S&P. And is highly levered across all the financial banks in the United States. Does that sound like subprime to you? It does to me. It goes on. Another important article posted on Zero Hedge. November was the worst month for crude since Lehman Brothers. And the article is covering a statement made by Deutsche Bank. It says for Brent, November was the biggest 1 month decline since the height of the Lehman crisis in October 2008. While for the WTI, it was the worst since December 2008. Brent and WTI are up. I hear a commercial coming up. Let me cover that on the backside of this break. Thank you for tuning in. Looking forward to hearing you on.
All right, Gabe, Elton back here. Had a little technical difficulty during the break. I love that technology. In fact, it's one of the sore spots for me. I never really jumped into the Internet because I kind of knew it was a tool for the controllers, if you will, and as a result, I'm still a little bit dysfunctional when it comes to what I like to call technology. But in any case, I'm glad to, hopefully you're still here with us, and I'm glad to be back here on the Rinse Radio Network. You're listening to Gabe Elton of the Austin Report. Today is December 10th, 2014. So I started the show talking about the current situation that we see heading into 2015 that's going to have an effect on the gold and silver markets. And one of the first things that I pointed out is, the American public has such a short memory when it comes to things such as these. They forget what happened to stocks in 2008. They forget what gold and silver have done since 2001. And even after this recent pullback in gold and silver prices, they're both up 33% since 2009. They're both up more than 400% since 2001, and on a long-term investment of 15 years have outperformed the Dow Jones by a factor of 4. So we also pointed out that the recent oil prices cause for concern, and that permits were collapsing and have collapsed by 40% from October to November as a result of this low oil price. People think that's good. It might be good when you're filling up your gas tank, but it's terrible for the economy because this economy is highly leveraged, and these financial institutions expect a large amount of money to come from the energy sector, and they've made big bets on it. It reminds us of subprime. And it just so happened that November was the worst month for crude since Lehman Brothers. And that is back in 2008, right before the big financial collapse. And that's what we think the price of oil is telegraphing, is a huge collapse coming in the stock markets. And I'm not the only one. Michael Snyder has correctly pointed this out. In fact, I'm going to be reading from his article here in a second. Charlie McGrath has also touched on this subject recently, put out a video regarding it. And the signs of the cracks are beginning to show. And people like myself, people like probably you guys that are listening to me tonight, are beginning to be vindicated. And I'm going to go right here to a Michael Snyder article that says, guess what happened the last time the price of oil crashed like this? And he goes on to say there's only been one other time in history when the price of oil has crashed by more than $40 in less than 6 months. It was during the second half of 2008. And the beginning of that oil price crash preceded the great financial collapse that happened later that year by several months. Well, now it's happening again, but this time the stakes are higher. When the price of oil falls dramatically, that is a sign that economic activity is slowing down. It can also have a tremendously destabilizing effect on financial markets. As you will read about below, energy companies now account for approximately 20% of the junk bond market. And a junk bond implosion is usually a signal that a major stock market crash is on the way. So if you're looking for a canary in the coal mine, keep your eye on the performance of energy junk bonds. If they begin to collapse, that is a sign that all hell is about to break loose on Wall Street. Now, that's not me saying this. That's Michael Snyder. He says it will be difficult to overstate the importance of the shale oil boom to the U.S. economy. Thanks to this boom, the United States has become the largest oil producer on the entire planet. Yeah, the U.S. now actually produces more oil than either Saudi Arabia or Russia. The revolution has resulted in the creation of millions of jobs since the last recession, and it has been one of the key factors that has kept the percentage of Americans that are employed fairly stable. But it's beginning to come to an abrupt end. And he goes on to point out that it seems that Saudi Arabia are engaged in a price war, and OPEC is engaged in a price war with the United States. They want to see how well these shell refiners, I keep saying shell refiners, let's call them what they are, frackers. They want to see how these fracking operations can put up with the lower price. And as I discussed earlier, there is a clear break-even price of $70 a barrel. We are well below that currently. And because all of this is so leveraged, that, like Michael Snyder points out, is from a Business Insider article, the energy sector accounts for roughly one-third of S&P 500 and nearly CapEx and nearly 25% of combined CapEx and R&D spending, which means big trouble for the financial markets. And he talks about how bad it's going to hit our financial institutions. And he recalls that the last thing that caused this once before was the housing crisis, like subprime. And the reason for this and the reason why it could happen, he says, is because of this fact that they make up 20% of all U.S. junk debt. And if that starts to fail, who is that debt owed to? And who do those institutions owe money to? And the counterparty risk is pervasive, and it's across the entire economy. And once that happens, it could be the beginning of the end. And even if it doesn't happen, the very fact that oil has fallen to these levels is a precursor, I believe, of what's to come in the broader financial markets. He even goes on to say, even the mainstream media is warning about this. From a CNN article, that it says that swing away from junk bonds often happens shortly before the stock market downturns. High yield does provide useful sell signals to equity investors, Barclays analysts concluded in a recent report. Barclays combed through the past dozen years of data. The warning signal they found is a 30% or greater increase in the spread between treasuries and junk bonds before a dip. Michael Snyder goes on to say, if you have been waiting for the next financial collapse, what you have just read in this article indicates that it is now closer than it has ever been. Over the coming weeks, keep your eye on the price of oil, keep your eye on the junk bond market, and keep your eye on the big banks. Trouble is brewing, and nobody is quite sure exactly what comes next. And there are other signs out there. Oil was a big one. Another huge one was Cyber Monday. It was a total dud. So was Black Friday. Was a big miss. And even the big guys are coming out. IBM put out a statement that said this was a big miss to expectations and is less than half the growth posted just last year when online sales grew at 17.5%, according to IBM. Bank of America came out and put out a warning saying that this is clearly a negative signal. They came out talking about this Black Friday and Thanksgiving spending. And their internal data showed a sluggish start to the holiday shopping season. Spending on Bank of America credit cards and debit cards over Thanksgiving and Black Friday declined 1.6% year over year. So these folks, all of these statisticians, all of these forecasters said that Black Friday and Cyber Monday was going to be a huge boom to the economy. Everyone was expecting huge growth. And if you listen to IBM, there was growth, but it was half of the growth that they saw last year and well below expectations. But I think the Bank of America data is even better because they're just looking at their credit card and debit card spending that, they own. I mean, they're spent on Bank of America credit and debit cards. And so it's very easy for them to look at this data. And they said it has declined 1.6% year over year. That is huge. The National Retail Federation came out and said that they experienced an 11% decline year over year. But I thought the consumer was doing better for lower oil prices. I guess both can't be true, can they? And keep in mind, it was the biggest dud since Lehman. The last time that the percentage change for Black Friday was this big and this negative was in 2008. Guess what else was the worst since 2008? The $40 price, or the $40 fall, rather, in the price of oil. November was the worst month for crude since Lehman. Well, guess what? The Black Friday year-over-year downward data was the worst since Lehman. And once again, Michael Snyder, and it's hard to go through and only touch on certain parts of Michael Snyder's articles. I find myself reading most of the article. And I hate to set up a situation like that, but this information is so important. He says retail sales during the 4-day Thanksgiving weekend were down a whopping 11% from last year. This is a make or break time of the year for many retailers, and if things don't turn around during the coming weeks, we could see a tsunami of store closings in January and February. As you read this article, there is already more than 1 billion square feet of retail space sitting empty in the United States. Many have described the ongoing collapse of the retail industry as an apocalypse, and this apocalypse appears to be accelerating. Yes, the shift to online retailers is a significant factor, but as you will see below, even online retailers struggled over the holiday weekend. The sad truth of the matter, and this is the heart of the matter that Michael Snyder touches on right here, is that U.S. consumers are tapped out and are drowning in debt at this point. So they simply do not have as much money to spend as they once did. And that's even with these lower oil prices. It says, he goes on to talk about the National Retail Federation that said they saw an 11% downward turn. We've already covered that in an earlier article. And, that's in the face of aggressive discounts. He says traffic at retailers was way down, and I've got a personal story about that. The retail industry is absolutely brutal at this point, he says. It is flooded with very large competitors that are chasing fewer and fewer disposable dollars. In order to thrive, retailers need financially healthy consumers. But over time, U.S. consumers have been getting deeper and deeper into debt. In fact, consumer credit in the United States has doubled since the year 2000. And as I always try to point out, consumer credit is not a good thing. That's debt. The United States consumer, the United States citizen, is in twice as much debt as they were 15 years ago. And my personal story regarding this, I recently, we are going to be rolling out a new website here at Austin Rare Coin and Bullion soon, and we wanted to get some new pictures, company pictures, and so I was forced, because that's one of the things that I really can't stand, is going to a mall or really to any clothing store. I just don't like dealing with the traffic. I don't like dealing with the people, and I don't like dealing with the corporations, if you will. But I was forced because I needed a white button-down shirt for the picture, and so I went into the mall. It was about 7:30 or so, and it was on a Tuesday night, and the mall was absolutely empty. I was able to park in the first row, right in front of the store there at Macy's. I walk into the department store, which is huge, 2 stories, no telling how many square feet, ton of items, ton of merchandise in there. And I saw less than 15 people in the entire store. The men's department is upstairs, so I had to walk all the way through the bottom, had to go up the escalator to the second floor, and there were more sales associates in the store than there were people. And they were giving it away, name brand stuff. You know, generally, if I'm going to buy clothes, I'll kind of sneak into a Ross, you know, so I don't have to go into the mall and buy a couple of shirts. I'm thinking I'm getting myself a huge discount, you know, buying a $50 shirt for $20 or this or that. And they were giving clothes away at Macy's, and there was no one there to take them. I was able to buy 7 name brand shirts. Most of them were sweaters. One of those was a white T-shirt, or not a T-shirt, but a white button-down, and a tie. So I had 7 shirts and a tie, and I got out of there for less than $200 after taxes. You know, if I figure if I'm going to go to the mall, I might as well buy as much as I can because I don't like stepping foot in there. But you know what? It was such a nice experience because there was no one there, and they were giving things away, and I got to park at the very front, that I might go back because that's the way. I don't mind shopping. But more importantly, I think it is a picture of America. You look at the sales associates that were in that store. You look at all the merchandise that was in that store. You look at the prices that they were selling that merchandise at, and how in the world are they going to be able to cover for their overhead, much less their employees? And I think that's an important point. And as the consumer is tapped out, as the United States consumer is drowning in debt, and, you know, that is the driver of the U.S. economy, is the U.S. consumer, followed by this oil boom and fracking, okay? Those are the 2 bright spots of the U.S. economy. Well, with oil below $70, you can kiss the fracking, you can kiss that goodbye. And with Macy's giving away clothes at below the price you would have to pay at an outlet like Ross. I don't know if there's Rosses all over the country, but here in the South, it's kind of like an overstock place. And you are literally paying more there than I was able to buy these clothes for at Macy's that was totally empty. And these Black Friday and Cyber Monday sales, it sounds like we're cut again because I was able to get a phenomenal deal. But you tie those 2 things in with the, I guess, nail that broke the camel's back, is that the United States debt passed $18 trillion a week and a half ago. And I don't know how many of you guys noticed that because I don't think many, if any, of the mainstream media networks even touched it at all. But total U.S. debt rises over $18 trillion, up 70% under Barack Obama. And this article is from Zero Hedge, and it says, as of the last workday of November, total U.S. public debt just surpassed $18 trillion for the first time. Now I'm going to break into this article right here because I didn't have time to do this before the show, but I hear the sound there. It sounds like a commercial coming up and the end of the show. Listen, visit our website, www.austinrarecoin or austincoins.com. Give us a call, 800-928-6468. I'm going to carry on this conversation in 2 weeks. We'll start right where we left off. Thank you guys for joining me tonight. See you in 2 weeks.
Bikes, roads, inside your market, your shops, your clothes. My dad, he's got a lot of fear, I know, but enough pride inside, nothing let that show. My brother had a book he would hold with pride, a little red cover with a broken spine on the back. He hand wrote a quote inside. When the rich wage war, it's the poor who die. Meanwhile, the leader just talks away, stuttering and mumbling for nightly news to replay. The rest of the world watching at the end of the day, both scared and angry like, what did he say?
You have been chosen, yes, you, to discover for yourself what thousands have already experienced, the most life-changing health product in the world. It's called Royal Velvet, and there's nothing else like it. Royal Velvet users testify to receiving hundreds of benefits, from reversing the effects of aging to mental clarity, as well as noticeably improved sleep, energy, libido, overall health, and so much more, including saving lots of money. This is the real deal, that once-in-a-lifetime opportunity that you will regret if you don't act upon it. Honestly, there is an extremely limited amount of raw material, making it available only to a select few, a very select few. So find out why you have been chosen. Go to RoyalVelvetNow.com, click on the rinse icon in the upper right-hand corner for an incredible surprise. Oh yeah, if you place your order before we run out of them, you will receive the eye-popping but simple-to-read book that tells you how to live in divine health, and it's free. RoyalVelvetNow.com.
Are you prepared for the future? Do you know how to navigate past the upcoming dangers before it's too late and seize budding opportunities before others do? Forecasting worldwide since 1980, Gerald Celente, publisher of the Trends Journal, provides timely and accurate trend forecasts that have earned him the reputation as the most trusted name in trends. The proof is in the hundreds of accurate forecasts Celente has made over the past 30 years. The 1987 stock market crash, the clean food trend, the dot-com bust. The Trends Journal alerts subscribers to early, subtle signs of crucial trends that will shape our future. It allows readers to anticipate change, recognize the implications, and take proactive strategies. Put your money where your mind is with Gerald Celente's brilliant and indispensable Trends Journal. Go to trendsjournal.com or call 845-331-3500. That's 845-331-3500.
You're listening to the Rense Radio Network, nationwide and worldwide on the net and at rense.com.